Hey everyone, this is Mike DeBliss. The topic of this podcast is on the IRS Whistleblower Program and cryptocurrency. This is actually an interesting area of tax law and one that has undergone a number of developments over the last couple of years. The anchor to lure you into this topic is the question, did you know that the IRS will pay you to turn in tax evaders? Not a lot of people are aware of it, but the IRS has a program that allows for an award to be made to people who assist the IRS in discovering violations of the tax laws, specifically in relation to the detection of underpayments and fraud by taxpayers. This program is called the IRS Whistleblower Program. Now, the Whistleblower Program has been in existence for nearly 150 years, but an act that was passed in 2006 called the Tax Relief and Healthcare Act made whistleblowing a much more lucrative pursuit than it was in earlier years. And by lucrative, what I mean here is that a whistleblower could receive up to 30% of the amount the IRS collects from the culprit. Now, I mentioned at the top that there have been developments that have occurred in recent years that substantially impact IRS whistleblower claims. A number of years ago, when this program was still in its infancy, there was a lot of ambiguity and uncertainty surrounding it. But this new law has cleared the way for tax whistleblowers to get paid top dollar for information provided to the IRS. Essentially, the IRS will now pay whistleblowers for information that leads not only to the collection of taxes and tax penalties, but also criminal fines, forfeiture, and fines for failing to disclose foreign bank accounts. That is a critical development and one that distinguishes the IRS whistleblower program from other whistleblower programs. What I mean by that is that there are whistleblower programs in other areas of the law, specifically in what is called qui tam actions. They are typically administered by the Securities and Exchange Commission. And in those actions, the whistleblower is exempt and not entitled to criminal fines and penalties. So you can see here that the fact that the IRS whistleblower program allows whistleblowers to potentially dip their beak into criminal fines, forfeitures, and fines for failing to disclose foreign bank accounts, that in itself makes it more lucrative than some of the other whistleblower programs, specifically the qui tam actions that are administered by the Securities and Exchange Commission. The other thing that makes the IRS whistleblower program very appetizing and more lucrative than the qui tam actions is that it tends to move quicker. With these qui tam actions, the whistleblower normally has to wait on the sidelines as a parallel criminal proceeding takes precedent over the civil qui tam complaint. Now, while it's not guaranteed that there may not be a parallel criminal proceeding that takes place while the IRS whistleblower investigation is being conducted, usually the rule of thumb is that the IRS does not always pursue criminal actions or criminal parallel proceedings as frequently and with the gusto that the Securities and Exchange Commission does. So that in itself reduces the amount of time that it takes for a whistleblower claim to be examined. And the other development here is that if you're familiar with foreign bank accounts, you know that that is the soup du jour, so to speak. It is the One thing that the IRS has become super focused on lately, ferreting out individuals who have unreported foreign bank accounts and assessing what could be very, very high penalties that correspond to the willful failure to file an FBAR, which is known as the Foreign Bank Account Report. So in connection with IRS whistleblower actions, the failure, knowledge of another person's failure to disclose foreign bank account reports could make the whistleblower eligible for an IRS whistleblower award. So for those reasons, the IRS whistleblower program has come to be known as one of the paramount whistleblower programs that the government that's in existence today that is being maintained by the government. Now, let's delve into the weeds a little bit to discuss the nuances of the whistleblower procedures and how to basically spark or jumpstart a whistleblower claim. Essentially, the whistleblower has to present specific and credible information to the IRS that the whistleblower believes will lead to collected proceeds from people that are believed to have failed to comply with the Internal Revenue laws. I realize that that's a mouthful. If we boil that down or distill it down to its core elements, what the IRS is saying here is that it wants specific and credible information that will lead to collected proceeds from tax cheats. That's essentially what the IRS is saying. So the more specific that it is, the better. And by specific, what the IRS is referring to is any supporting documents along with the allegation, so that it's not simply just a hollow allegation, but it's one that has supporting documentation that supports the allegation being made. And of course, it's got to be credible. As with any matter that is being claimed in court, it has to have a good faith basis. It cannot be one that is brought, in a scurrilous way or in a way that lacks any credibility, because at the end of the day, you could potentially be at risk for penalties and sanctions yourself if you make a baseless claim. So now we're going to get into the forms that have to be prepared. And I realize that these forms become a little bit complicated and can muddy up the waters, but it's actually easy to access these forms by merely putting the number of the form into Google, and usually the form pops right up, and you can actually type the information directly into the PDF version of the form after you download it. To claim an award, a whistleblower must file Form 211, and that form is called the Application for Award for Original Information. The form is filed with the Whistleblower Office of the IRS. What does the form include? Well, it includes a lot of information, essentially background information ranging from the date of the claim, the whistleblower's name, the whistleblower's address and telephone number, the whistleblower's date of birth, the whistleblower's taxpayer identification number, which is usually the Social Security number, and, this is really important, an explanation of how the whistleblower obtained the reported information and his or her relationship to the persons identified on Form 211, meaning the person who the whistleblower is claiming is the tax cheat. There's also a section on Form 211 that is provided to describe the alleged violation. And again, as I mentioned before, not only is there a section for a description of the alleged violation, but the IRS likes details, they like specificity. So that section also requests an explanation of the noncompliance, and it gives the whistleblower an opportunity to attach any supporting information that's in the whistleblower's possession. So, the IRS, wants to make sure that there is supporting information to back up the claim, because it's very easy to, shout from the rooftops that, so-and-so is non-compliant with their tax obligations, or so-and-so has failed to report an FBAR and has hundreds of thousands of dollars parked in an offshore account in Switzerland. It's another thing to be able to provide documentation to back up those claims. In keeping with the cliche, actions speak louder than words, in the world of whistleblower claims, substantive documentation speaks louder than words. So of course you have to describe the alleged violation, but you also have to get into an explanation of the noncompliance and explain how you came to find it out and attach any supporting information that's in your possession. Within 30 days of receipt of Form 211, the IRS will send an acknowledgement letter to the whistleblower. After the IRS has reviewed the information and taken steps to investigate and collect any taxes, fines, or penalties owed, essentially what they do is they investigate the information that you provided in Form 211. And after they've completed their investigation, they then prepare what's called a Form 11369 or 11369. That form is called the Confidential Evaluation Report on Claim for Reward. The investigation or the review rather of Form 211 is undertaken by the whistleblower office. Form 11369 basically explains and supports whether the information supplied by the whistleblower was used and whether the information did or did not result in identification of the issues that were alleged. The IRS is basically preparing that form to say whether the information led to something or whether it didn't, whether it was helpful or whether it was unhelpful. Once the taxpayer, and now let's assume that the information was used by the IRS and the information did contribute to the collection of taxes, fines, or penalties. In that case, once the taxpayer who was the target has been paid in full, an award recommendation will be prepared by the whistleblower office and sent to the whistleblower. Now this is where it gets interesting. If you've made it to that point and the IRS whistleblower office has acknowledged that the information that you supplied in Form 211 was not only helpful but actually resulted in the collection of taxes, fines, or penalties owed, what they're saying right now is that the whistleblower office is going to send you an award recommendation. They're basically going to tell you that we are awarding you X, and X is basically the monetary amount. You then, as the whistleblower, have 30 days to either agree or disagree with the award recommendation. So there is a right to actually appeal the award. And to the extent that the whistleblower feels that he's been or she's been cheated, perhaps because the IRS forgot to calculate the criminal fines, a percentage of the criminal fines that they collected from the target in the award, or perhaps there was an issue relating to forfeiture and the IRS did not calculate a forfeiture award for the whistleblower. Any one of a number of issues could result in the taxpayer wanting to appeal the award. But there's got to be a good faith basis. It can't just be that the award is too low because you thought that the amount of taxes that were owed should have been a lot higher than what was collected. Again, we're dealing with the taxes that were collected. So it's a good practice to consult with a lawyer before acquiescing or agreeing to an IRS whistleblower award if you've already come that far on your own. Certainly it's good practice to get a lawyer involved at the very onset before you even file 211 so that you can present your a strong and compelling case. Now, again, the whistleblower has 30 days to either agree or disagree with the award recommendation. I want to talk a little bit about this issue of proceeds. There's been, over the years, an incredible battle over the definition of proceeds, and I alluded to it earlier and have been mentioning it throughout this podcast, where the IRS has basically argued that any fines or penalties it obtains should not be credited in the award to the whistleblower. So the IRS used to interpret proceeds under the program to be limited only to taxes and tax penalties. Just to the taxes. Proceeds under the program so the IRS's argument has essentially been that any fines or penalties it obtained should not be credited in the award to the whistleblower. And that's been the tension that has taken place between the IRS and whistleblowers for years. In fact, it led to litigation in a case called Whistleblower 21276-13W versus Commissioner. In that case that was presented before the United States Tax Court, the tax court actually agreed with the taxpayer that criminal fines and civil forfeitures constitute collected proceeds on which whistleblower awards may be paid. The court explicitly said in its opinion that collected proceeds is very broad and sweeping in scope and is not limited to amounts assessed and collected under Title 26. And so the tension and the battle over defining proceeds basically was resolved by the U.S. Tax Court, interpreting collected proceeds as being broader than what the IRS interpreted it as meaning. Again, the IRS argued that any fines or penalties it obtained due to the whistleblower's information should not be credited in the award to the whistleblower. The whistleblower basically was arguing in this case that it should be entitled to an award on everything, the whole kit and caboodle, from the unpaid taxes to the fines to the penalties, etc., etc. Now, the IRS threatened to appeal the decision of the tax court that had ruled in favor of the taxpayer. Thankfully, Congress stepped in before the appeal happened and before one of the circuit courts actually granted cert to hear the appeal. Congress, in responding to this litigation and the lobbying, stepped in and codified is just a fancy word to say that they made it into a statute. So they basically took the broader definition of collected proceeds
that was given by the tax court, and they codified it by inserting it into the statutes, and so that it reflected the intent of the statute. The tax court interpreted the statute to mean that collected proceeds was broad enough to include fines, penalties, and as well as forfeiture, etc., etc. And so Congress stepped in, and they wanted to reflect the intent of the statute, and in doing so, they basically defined collected proceeds to be as broad as the tax court did. And so now what we have is the new legislation that's been signed into law by President Trump that now settles the debate once and for all. And the benefit of this is that whistleblowers are clearly the winners, in the sense that they are entitled to a lot more under the collected proceeds definition than they previously were. Per the statute, the new definition of collected proceeds allows IRS whistleblowers to be paid a percentage of whatever criminal fines, forfeiture, or non-tax related penalties the IRS collects. And that's interesting, because non-tax related penalties is sweeping, because a lot of times when a person is charged with an IRS tax crime, there are accompanying other crimes as well, from any one of a number of federal crimes such as money laundering to obstruction of justice. There are other charges that usually accompany IRS-related criminal charges. So what this is saying here is that the whistleblower is entitled to be paid a percentage of whatever criminal fines, forfeiture, or non-tax related penalties the IRS collects. The new legislation, of course, led to the dismissal of the appeal that the IRS had sought in the Whistleblower 21276 case, in which they were seeking reconsideration of the term's definition. Now, here's the practical reality of this new definition of collected proceeds. It has had its greatest impact on financial institutions and Fortune 500 companies. And what do I mean by that? Well, with criminal fines in excess of $1 billion being assessed against these big companies and these big banks and these big Fortune 500 companies, whistleblowers who come forward stand to collect hundreds of millions of dollars. Here are two examples. In 2008, there was an accountant by the name of Daniel Schlicksup. He worked for the company Caterpillar Incorporated. I believe that was the company that builds big warehouse equipment and machinery. Forklifts are one that come to mind right away. Daniel blew the whistle on what he believed to be questionable international tax practices with Caterpillar. According to emails sent from Schlicksup to executives within the company, Caterpillar's corporate structure lacked economic substance and was reorganized primarily for tax avoidance. As a result, the IRS claimed that Caterpillar owed more than $2 billion in back taxes. Now, under the IRS, and I'm going to give you a comparison here, under the IRS's former view of collected proceeds, Daniel Schlicksup would have been eligible to earn between $300 million and $600 million if Caterpillar paid the full amount owed. Now, after the new legislation was enacted, Schlicksup stands to receive a heck of a lot more. He would receive not only the initial $300 to $600 million, but on top of that, a percentage of all fines and penalties incurred. And so, as you can see here, the enactment of the new legislation that broadened the definition of collected proceeds just doubled this man's whistleblower award. And that was based on the fact that it is broad enough to include the fines and penalties incurred. If the IRS had won, then it would have precluded Schlicks from receiving fines and penalties incurred. The other example I wanted to provide you with was the UBS group prosecution, and that also dates back to 2008. I realize we're going back a little bit in time. As many are aware, the IRS has aggressively pursued taxpayers with unreported assets and bank accounts that are located outside of the United States. As many know, the penalties for not reporting these foreign assets to the United States can go into the stratosphere. They are substantially greater than the tax that would have otherwise been owed to the IRS on the interest income generated by the account. So it's actually an oxymoron, but in the world of FBAR penalties, the penalties are so high that they could be as much as 50 to 100 times more than the tax liability on the unreported interest generated by the foreign account. So for example, with a willful FBAR violation, the penalty is the greater of 50% of the highest maximum aggregate balance in the account, or $100,000, whichever is greater. So to give you an idea and to put this into perspective, if we're dealing with an unreported bank account, say in Switzerland, that had a high balance of $500,000, again, we're dealing with the high balance. That's what drives the FBAR penalty. If the highest balance in the foreign bank account was $500,000, that triggered an FBAR filing requirement, because anything over $10,000 US as a high watermark at any time during the tax year automatically triggers an FBAR. But if we're dealing with an example where the high watermark balance was $500,000 and it wasn't reported, the IRS could assert a willful FBAR penalty that would be either 50% of that high balance, 50% of $500,000, or $100,000, whichever is greater. As in this example, 50% of $500,000 is $250,000, and that's greater than $100,000. That would be the penalty just on that single account for a willful FBAR violation. Now, the interest income generated by that $500,000 account would likely create a U.S. tax liability that may not exceed more than just $1,000 U.S. or a few $1,000s. So one can imagine how radical the difference is between the actual FBAR penalty for willful versus what the tax liability would be if the account had been reported on the FBAR and had been reported on the taxpayer's individual income tax return. So, in hindsight, a lot of times it's easier just to report the account, and as much as the compliance will create some additional fees to the accountant for preparing an FBAR, at the end of the day, paying the tax liability and paying the accountant the additional amount that is owed for preparing the appropriate forms is far less expensive than the risk of paying a willful FBAR penalty. A non-willful FBAR penalty, on the other hand, has a high penalty of $10,000. So the IRS has a number of obstacles to overcome in order to assert the willful FBAR penalty, but nonetheless, they've done so in the past and they continue to do so, and the risk of getting ensnared in a willful FBAR penalty where you might literally have to leverage your house, mortgage your house in order to pay the penalty is so much more draconian than simply paying the taxes on the interest income that's generated, take advantage of all foreign tax credits that are available, and pay your accountant or tax preparer the amount that he or she demands to prepare the additional forms. So getting back, and I realize I went off on a tangent here, but getting back to the UBS example, the UBS prosecution back in 2008 is interesting because the new law now makes the penalties associated with not disclosing foreign assets, including not filing a foreign bank account report, subject to whistleblower collection. The penalties, as I discussed, for failing to file an FBAR can be as high as 50% of the unreported bank account, highest balance of the unreported bank account, for each year the FBAR was willfully not filed. So here's the example. If an in-house bookkeeper knows that an executive of the company has an unreported $10 million bank account, the bookkeeper could collect from the IRS a portion of the potential $5 million penalty the executive pays to the IRS for willful non-filing of the FBAR. Now, I want to also talk about something that the new law opens the watergates for, or essentially opens the floodgates to. It opens the floodgates to potential whistleblowing to the IRS in the sphere of cryptocurrencies. Here's what I mean. If a whistleblower is aware of the use of cryptocurrency to evade taxes, and the IRS, based on the tip, begins an audit and collects money, the whistleblower is entitled to an award. Under the new law, if the cryptocurrency was used for an illicit purpose, such as a fraud scheme, and the IRS seizes the actual cryptocurrency, the whistleblower could receive between 15 and 30% of the seized virtual currency. So the new broader definition of proceeds creates an incentive to provide information to the IRS because it now expands the penalty that the whistleblower could claim to include criminal fines and forfeiture. Now, I realize that a lot of what I talked about here is very technical in nature and might be a little bit confusing. If you have any questions about anything that was discussed, or if you're not sure if you should proceed or need help even filling out a form, feel free to shoot me an email, and I'd be more than happy to assist you in any way I can. My email is mjdebliss@deblisslaw.com. At the end of the day, by reporting these illegal activities, not only will you be doing the right thing, but you could, of course, be ensuring yourself a lucrative award down the line.